Marcus gets the call at 7:43 a.m. on a Tuesday. $8.7 billion inheritance crisis unfolding in real time as three heirs can't agree on preserving their pharmaceutical fortune. Across the country in Palo Alto, Elena celebrates her client's $2.1 billion acquisition that just closed, already planning the next aggressive expansion. Two billionaire financial advisors, two completely opposite philosophies about what money should actually do. By February 2026, Marcus has transformed his approach into a fortress. Multi-jurisdictional trusts spanning from Jersey to Liechtenstein, designed to protect his clients' assets from lawsuits, political instability, and tax exposure across generations. His pharmaceutical heir crisis gets resolved through what he calls defensive architecture, complex trust arrangements that consider multiple jurisdictions while appointing trustees who understand the intricate web of international law. The $8.7 billion inheritance now sits protected behind layers of legal structures that would take decades to penetrate. Elena, meanwhile, doubles down on her growth philosophy. She views market volatility as opportunity, pushing her tech billionaire clients toward AI investments that dominated 2025. Her client's $2.1 billion acquisition becomes the foundation for an even more aggressive expansion into artificial intelligence startups, betting that the next wave of wealth creation flows through emerging technology rather than defensive positioning. But Marcus remembers the $340 million disaster that shaped his entire philosophy. A client who followed Elena's aggressive approach in early 2025, investing heavily in tech stocks just before a market correction wiped out the position. His client's fortune evaporated in those 48 hours, a reminder that preservation isn't just about growing wealth, it's about ensuring it survives the inevitable storms. The philosophical divide between them crystallizes around this moment. Marcus builds bunkers, Elena builds rockets, and both approaches carry the potential for spectacular success or catastrophic failure. 3 weeks after the pharmaceutical crisis resolution, Marcus receives an urgent call at 2:17 a.m. One of his tech billionaire clients needs $50 million in liquidity by market open. The client's $2.3 billion portfolio becomes collateral for a pledged asset line of credit, allowing access to cash without triggering capital gains taxes on appreciated stock positions. Marcus structures the credit line at just 2.4% above SOFR, with borrowing capacity capped at 40% of portfolio value while maintaining ownership of the investments. Elena takes a different approach when her client faces the same liquidity crunch. Instead of traditional credit lines, she constructs a complex derivatives arrangement, selling covered calls against the position while simultaneously purchasing protective puts. This securities-backed strategy provides immediate cash flow without selling underlying assets, but creates a web of interdependent positions that amplify both potential gains and catastrophic losses. The philosophical divide becomes starkly visible when margin calls cascade through the system in early 2026, forcing institutional players to liquidate their most liquid winning trades to raise immediate cash. Marcus's client weathers the storm. The conservative 40% loan-to-value ratio provides cushion against market volatility. Elena's client, however, faces a nightmare scenario. By February 2026, with markets down 40% from their peaks, the leveraged derivative positions trigger automatic liquidations worth $1.8 billion in just 48 hours. The very liquidity mechanisms Elena had constructed to provide flexibility became the client's destruction, forced to sell profitable assets to cover losing positions in what became a market panic. Marcus studies the wreckage and sees validation of his preservation philosophy, but Elena views it differently. She argues that the $1.8 billion loss, while devastating, represented calculated risk-taking that could have generated massive returns in a different market environment. The question hanging over both advisors, in a world where billionaires need instant access to hundreds of millions, which approach actually serves wealth better? The fortress that survives every storm, or the rocket that reaches for exponential growth despite the risk of explosion? After watching Elena's client lose $1.8 billion in just 48 hours through forced liquidations, which approach would you trust with your own wealth? Marcus's fortress strategy, or Elena's rocket approach? Comment your answer below. Now let's see what happens when both advisors face their biggest test yet. 4 months after the liquidity crisis that destroyed Elena's client, Marcus receives the call he's been dreading. Another pharmaceutical heir, different family, but the same generational wealth transfer crisis that's plaguing billionaire families across America. This time it's the Hartwell pharmaceutical dynasty facing complete collapse after 3 generations systematically destroyed $12 billion through what Marcus calls Heir incompetence syndrome. Marcus immediately deploys his preservation philosophy through what he calls dynasty architecture, establishing trusts that can span up to 1,000 years across 40 generations in states like Florida and Wyoming, designed specifically to prevent the Hartwell heirs from accessing principal while still providing income streams. His legal team constructs what amounts to a financial fortress spanning multiple jurisdictions, with trustees appointed across different countries to ensure no single government can dismantle the structure. Elena watches this unfold with growing frustration. While Marcus builds his 1,000-year bunkers, she's teaching the next generation of tech billionaires how to multiply their inheritances through aggressive growth strategies. But the fundamental problem plaguing both approaches becomes clear. Communication breakdowns are the single most common source of conflict in ultra-wealthy families, cited by 33% in the UBS Global Next Generation report, ahead of disagreements over spending habits or fairness. Nearly half of all surveyed heirs say the previous generation conducted no structured wealth transfer at all, leaving successors to inherit not just assets, but ambiguity. The Hartwell family exemplifies this perfectly. 3 generations of heirs who inherited billions but never learned the discipline, vision, or financial literacy that built the original fortune. Marcus's dynasty trusts might preserve capital for centuries, but Elena questions whether they're creating a different kind of destruction. Heirs who become permanent dependents on trust distributions, never developing the entrepreneurial drive that created the wealth in the first place. The philosophical divide deepens. Is it better to preserve wealth that slowly corrupts its inheritors, or teach them to multiply it while risking everything in the process? 6 months into the crisis, Marcus discovers something that makes his preservation philosophy seem almost naive compared to what his clients are actually doing behind the scenes. While he's been constructing 1,000-year trusts and dynasty architecture, his pharmaceutical heir client quietly reveals the family's $400 million political strategy that saved them $6 billion in tax obligations through strategic think tank funding and lobbying efforts. Marcus realizes his fortress approach extends far beyond financial structures. His clients systematically fund policy research organizations that shape tax legislation decades before it reaches Congress. The pharmaceutical heir explains how their family foundation channels $50 million annually through intermediary nonprofits to think tanks that produce academic papers supporting specific tax provisions. The donation structure allowed the family to avoid $400 million in taxes, while simultaneously influencing the very laws that govern wealth taxation. Elena takes a radically different approach to political influence. Where Marcus's clients fund quiet, long-term policy research, Elena's tech billionaires back disruptive political movements and candidates who promise to reshape entire regulatory frameworks. Her AI billionaire client spent $180 million supporting candidates who advocate for federal preemption of state-level AI regulations, viewing political chaos as opportunity rather than threat. The philosophical divide crystallizes around a single question: should billionaires preserve wealth within existing systems, or should they reshape the systems themselves? Marcus watches his preservation strategies seem fundamentally outdated as Elena's clients engineer the political change that protects their wealth, betting that $400 million in strategic political investments can generate returns that dwarf any trust structure Marcus could design. By May 2026, 18 months after the pharmaceutical crisis and the devastating liquidation cascade, both advisors face a reckoning that exposes the brutal mathematics beneath their philosophical divide. Marcus's preservation clients weathered every storm: the March tech sell-off, the August currency crisis, even the September regulatory crackdown on AI companies. His fortress approach proved resilient as his client base maintained portfolio stability through volatility that would have triggered forced liquidations under Elena's strategies. Elena's growth philosophy, meanwhile, extracted a price that transcends money. Her surviving clients, the ones who didn't lose everything in forced liquidations, generated returns that dwarf Marcus's conservative gains, but at a cost that becomes clear only when you examine what happened to their families. 3 of her tech billionaire clients went through divorces directly triggered by the financial stress of managing leveraged positions. 2 more developed what their private physicians quietly diagnose as wealth anxiety disorder, a condition that doesn't exist in medical textbooks but affects ultra-wealthy individuals who can't sleep, knowing their net worth fluctuates by hundreds of millions daily. Marcus discovers the darkest truth about his preservation philosophy when he reviews client satisfaction surveys in late April. His billionaire clients report feeling financially secure but existentially empty, describing their wealth as a fortress that became a prison. The multi-generational trusts he constructed so carefully have created what one pharmaceutical heir calls inherited helplessness, children and grandchildren who will never experience the entrepreneurial drive that built the original fortune. But both advisors learn the same lesson when they compare notes at a private dinner in Manhattan. In 2026, performance is no longer measured only by growth. It is measured by resilience. Every billionaire client, regardless of strategy, follows one unbreakable rule. They never put more than 30% of their wealth at risk in any single approach. The preservation clients secretly maintain growth positions. The growth clients quietly build preservation structures. The philosophical divide that seemed so stark dissolves into a more complex truth. Billionaire-level wealth demands both the fortress and the rocket, because at these scales, the cost of being wrong isn't just financial bankruptcy, it's generational destruction. Subscribe for more billionaire wealth breakdowns and watch how they actually spend their money next.